Introduction. Let's start with something extremely simple. Imagine you walk into a bank and deposit $10,000 into a savings account. From your perspective, you now have $10,000 in the bank. You can check your balance on your phone. You can transfer money. You can withdraw cash. You can use a debit card. It feels like the bank is simply storing your money. But economically, something different is happening. Your deposit is also a liability of the bank. Why? Because the bank owes that money to you. If your account says $10,000, the bank has an obligation to honor your withdrawal or payment, subject to the account terms. On the other side of the bank's balance sheet are its assets. These can include loans to households and businesses, securities, cash, and other assets. And this is where the business model begins. A bank essentially sits between people and businesses who have money and people and businesses who need money. It helps move capital through the economy, and it gets paid for doing that. 1. The basic banking business. Let's imagine a bank called North Star Bank. Suppose thousands of customers deposit money into North Star. Some people keep money in checking accounts, others use savings accounts. Businesses may keep operating cash there. Now, at the same time, another group of customers wants to borrow money. Someone wants a mortgage, someone wants an auto loan. A small business wants money to buy equipment. Another company wants financing to expand. The bank evaluates these borrowers and, when appropriate, provides loans. And borrowers pay interest. That interest becomes one of the bank's major sources of revenue. But there's an important detail. The bank may also pay interest to depositors. So let's make the example extremely simple. Imagine a bank receives funding that costs it an average of 2%. It then makes loans that generate an average of 6% in interest. The difference is roughly 4 percentage points before considering other costs and risks. This basic idea is connected to what is often called the net interest margin. It's one of the most important concepts in banking. But don't think of it as bank pays 2%, bank gets 6%, therefore bank keeps 4%. Real banking is much more complicated. Banks have employees, they have technology costs, they have branches, they have regulatory expenses, they have funding costs beyond deposits, and most importantly, some borrowers don't repay their loans. That brings us to the next part. 2. Why loans are so important. Think about the most common things people borrow money for: homes, cars, education, business expansion, equipment, working capital, credit cards, personal expenses. Every time a bank makes a loan, it expects to receive money back over time, usually with interest. For example, imagine a bank provides a $300,000 mortgage. The borrower doesn't simply return $300,000. Depending on the interest rate and repayment schedule, the borrower may pay substantially more over the life of the loan. That additional amount includes interest. For the bank, interest income can be a major revenue source. Now imagine a bank has thousands or millions of loans. Even relatively small interest payments can add up to enormous amounts. This is why lending is central to traditional banking. But there's a catch. Banks don't just want to make as many loans as possible. They want to make loans that are likely to be repaid. Because a loan that generates interest is useful, a loan that turns into a major loss can be extremely expensive. 3. The bank is taking a risk. This is something many people forget. When a bank lends you money, it isn't guaranteed that the bank will get everything back. Imagine a bank gives someone $50,000 for a business. The business struggles, revenue falls, the owner can't make payments. Eventually, the loan may become delinquent or default. Now the bank has a problem. It may have to recognize a loss or set aside money to cover expected losses. That's why banks spend so much time analyzing borrowers. They may look at income, credit history, existing debt, collateral, cash flow, business performance, and many other factors. The bank is essentially asking, if we give this person or business money today, how likely are we to get our money back? The better the risk assessment, the better the bank can price the loan. A riskier borrower may face a higher interest rate. A highly creditworthy borrower may receive a lower rate. So interest isn't simply the price of money, it also reflects risk, funding costs, competition, and market conditions. 4. Your deposit is not free money. Now let's return to your $10,000 deposit. You might think, if the bank can use my deposit to make money, why does it pay me interest? Because your money has value to the bank. Deposits can provide banks with a relatively stable source of funding. But banks compete for deposits. If one bank offers almost no interest while another offers an attractive rate, customers may move their money. So banks have to balance two things. They want funding that is useful and stable, but they don't want to pay more for that funding than necessary. This creates a competition for deposits. And this is one reason interest rates on savings accounts can change over time. When market conditions change, banks may change what they're willing to pay depositors. 5. Checking accounts can also be valuable. Here's something interesting. Not every bank account pays a high interest rate. Traditional checking accounts may pay little or no interest, yet banks still compete heavily for checking customers. Why? Because a checking customer can generate value in many other ways. Think about what happens when you use a bank account. You might have a debit card, you might send payments, you might receive direct deposits, you might use an ATM, you might transfer money, you might use online banking, and some customers may eventually need a credit card, mortgage, auto loan, or business account. So the customer relationship itself can be valuable. A bank isn't necessarily thinking, how much money can we make from this one transaction? It may be thinking, how valuable is this customer relationship over many years? That changes the entire business model. 6. Banks also make money from fees. Interest isn't the only source of bank revenue. Banks can also earn money from various fees and services. For example, account-related fees, certain wire transfer fees, investment and advisory services, loan origination or processing fees, credit card-related revenue, merchant payment services, foreign exchange services, and many other financial products. The exact fees vary by institution and account, but the basic idea is simple. Banks don't just sell money, they sell financial services. Think about a small business. The business may need a checking account, payroll services, payment processing, business loans, credit cards, cash management tools, international payments. The bank can potentially serve many of those needs. That's why banking is much broader than simply taking deposits and making loans. 7. The credit card business. Now let's talk about one of the most profitable-looking areas of banking from a customer's perspective, credit cards. Suppose you buy a $1,000 laptop with a credit card. The merchant gets paid through the payment system. You now owe the card issuer money. If you pay the entire balance on time, you may avoid interest charges on purchases depending on the card's terms and grace period. But if you carry a balance, interest can become significant. This creates another important revenue stream for card issuers. Credit cards can also generate other types of revenue connected to transactions and fees, but again, there's risk. The bank or card issuer has to deal with customers who don't repay. So the business is a balance between revenue, customer spending, funding costs, operating expenses, and credit losses. 8. What about mortgages? Mortgages are another huge part of banking. Let's say you want to buy a $400,000 home. You don't have $400,000 sitting in your checking account, so you apply for a mortgage. The bank evaluates your finances. If approved, financing is provided. You then make monthly payments. Those payments typically include both principal and interest. Over time, the principal balance declines. Interest is the cost of borrowing. This creates an income stream for the lender. But there's another fascinating thing that can happen. The bank doesn't necessarily have to hold every mortgage until the borrower makes the final payment decades later. Some loans can be sold or transferred into financial markets, depending on the type of loan and market structure. This can allow lenders to recycle capital and continue making new loans. And that's one reason the modern financial system is much bigger than the local bank branch you see on the street. 9. Banks don't just lend to individuals. When most people think about bank loans, they imagine mortgages or car loans, but businesses borrow enormous amounts of money too. Imagine a company wants to build a new factory. It may need hundreds of millions of dollars. A bank may provide financing directly or participate in a larger lending arrangement with other financial institutions. Businesses borrow to expand. They borrow to purchase equipment. They borrow for working capital. They may borrow for acquisitions. They may borrow during periods when cash flow is temporarily weak, so banks help connect savings and capital with productive economic activity. That's one reason banks play such an important role in the economy. 10. The part most people don't understand: money creation. Here's something most people misunderstand about banking. When a bank approves a loan, it doesn't always take the exact same cash from another customer's account and hand it over. Instead, the bank can create a deposit for the borrower while recording the loan as an asset. So lending can create new bank deposit money, but banks can't create unlimited money. They face capital, liquidity, regulatory risk, and funding constraints. 11. What happens when everyone wants their money? Normally, banks don't expect everyone to withdraw their money at once, but if customers suddenly lose confidence and rush to withdraw their deposits, a bank run can happen. That's why banks carefully manage liquidity and maintain access to liquid assets and other funding sources. Modern banking systems also have safeguards designed to reduce the risk of bank runs. At its core, banking depends heavily on trust and liquidity. 12. Why banks care so much about interest rates. Interest rates can have a huge effect on bank profits. If a bank's funding costs rise faster than the interest it earns from loans, profits can come under pressure. But if loan rates rise while funding remains relatively inexpensive, interest income can increase. That's why changes in interest rates can affect savings accounts, mortgages, credit cards, businesses, and banks themselves. 13. Why banks don't keep all their money in cash. Banks don't simply keep all their resources sitting as cash. They need enough liquidity to meet withdrawals and payments, but they also need assets that can generate returns. So banks balance liquidity, safety, and profitability. Too much risk can create losses. Too much idle cash can reduce returns. Managing that balance is a major part of running a bank. 14. The bank's real product is trust. A bank's most valuable product isn't just money, it's trust. Customers trust banks to protect their deposits, process payments, and provide access to their money. Businesses depend on banks to move large amounts of money. If that trust disappears, a bank can face serious problems very quickly. That's why reputation and confidence are extremely important in banking. 15. Where does the bank's profit actually go? Bank revenue isn't the same as profit. Banks have to pay for employees, technology, branches, cybersecurity, compliance, marketing, loan losses, funding, taxes, and many other expenses. After all these costs and losses are accounted for, what's left contributes to profit. So a bank making billions in revenue doesn't mean it keeps billions as profit. 16. Why banks need capital. Banks need a financial cushion because lending always involves risk. Some borrowers won't repay their loans as expected. Capital helps banks absorb unexpected losses and continue operating. That's why regulators require banks to maintain minimum levels of capital relative to their risks. The simple idea is banks need a safety cushion before they can safely take risks. Conclusion. So the next time you open your banking app and see your balance, remember what's happening behind that number. Your bank isn't simply sitting on a pile of cash with your name on it. Your deposit is part of the bank's overall balance sheet. The bank uses funding, manages assets, makes loans, provides financial services, manages risk, and earns revenue from multiple sources. Interest from loans can be important, fees can matter, payment services can matter, credit cards can matter, business banking can matter, investment and advisory services can matter. But the real skill of banking is managing all of these pieces while keeping enough liquidity and capital to survive difficult periods. And that's what makes banking so interesting. A bank's business isn't simply take money, lend money, make profit. It's much closer to manage money, risk, trust, liquidity, and time at enormous scale. And once you understand that, you start seeing banks differently. The savings account on your phone, the mortgage on a house, The credit card in your wallet, the loan taken by a business, and even the interest rate decisions you hear about on the news, they're all connected to the same financial system. Money doesn't just sit still, it moves, and banks are one of the major systems that help move it. If you found this explanation useful, subscribe for more simple breakdowns of the financial system, investing, banking, and the hidden mechanics behind money. Because sometimes the best way to understand money is to understand what happens behind the scenes.